Good morning, good afternoon, and good evening. We're going to start the presentation shortly. We're going to give people a minute or so to join. We'll kick off. Welcome to our webinar, Rays of Hope, Planning for the M&A Recovery Ahead. My name is Richard Martin. I'm the Chief Business Officer of Mergerware, and I will be your moderator today. The COVID-19 pandemic has brought unprecedented challenges to the global economy, shutting down businesses and social activity in every corner of the world. The initial reaction of companies to the crisis has been to focus on implementing business continuity plans and virtualizing operating models, and many organizations have done so successfully. As companies continue to navigate the storm, officials in the US and abroad are implementing staged plans to restart industry. The situation is likely to be the defining moment of our lifetimes. Mergerware and M&A partners have joined together to offer insights about what companies can be doing now to prepare for a return to business. And we are delighted to be joined by John Bender, who is the president of M&A Partners, and Michael Murray, who leads their M&A software services practice. John has more than 20 years of mergers, acquisitions, divestiture, and corporate transformation experience. And Michael has tremendous experience in evaluating software solutions and has developed a comprehensive diagnostic process for organizations seeking to improve their capabilities. So today we're going to cover a few things: the implications of the current macroeconomic situation on deal types, objectives, pace, and volume for the second half of this year. We're going to cover those elements of a company's internal M&A capabilities that equip an organization to execute M&A successfully in this environment. And we're going to discuss the near-term action strategies and investments that corporate acquirers can implement now to accelerate their ability to maximize M&A success this year. A couple of things before we get started. Please send any questions you have during via the questions panel, and please send them throughout. We're going to hopefully engage with the group as we go. Looks like maybe our webcams have started working. We will answer questions as time permits, and of course, we'll send out the replay and slide deck within 48 hours of the presentation. I also want to mention that throughout the presentation, we'll have a number of polling questions. And in fact, why don't we start with that? And the first polling question to the audience, is going to be about, let me launch that now. We'd like to know what your predictions are for when deal activity will return. 3 months from now, 6 months from now, 12 months, or over a year from now. We'll take a moment to gather some votes. You know, John and Michael, I'm noticing that there's primarily people are mentioning 6 months from now, with some of the data coming in at 12 months. But generally speaking, it's 6 to 12 months is kind of the range. Does that surprise you? Seems to be expected.
Richard, that doesn't surprise us at all, and I think as we delve into the dialogue, we'll be able to cite some good data and expert opinions that back that up. But that seems to be the general consensus.
Excellent. Okay, I think we have most people have voted by now, so let's close the poll and we can move on to our next question. So John, now I want to talk a little bit about the macroeconomic situation. We have some data here from Merger Market. Maybe you can take us through this, but as you can see, there's been a significant fall off in activity so far this year as expected. But why don't you take us through your observations here?
Sure, thanks, Richard. Well, I think it is important to start with a bit of context before delving more deeply into the specific focus areas for today. And the data on these charts really epitomizes the phrase, all great changes are preceded by chaos. Business abhors uncertainty, and so more do M&A deal makers. And the data shows from our partners here at Merger Market that changes were afoot well before the COVID-19 pandemic. M&A deal making value in 2017 and 18 peaked in the U.S. Then and through Q2 of 19, and then it started to tail off. In Q3, value was off nearly 50%, though transaction volume was still pretty robust, and that continued into Q1. Of course, chaos and uncertainty caused by the coronavirus were the big influences in Q1, and by late March, the U.S. was becoming the global epicenter of the coronavirus pandemic just 3 months after the first cases broke in China and then followed in Europe. So net, deal makers and corporate executives who are already bracing for the natural shifts in the business and M&A cycles now had additionally compensate for the tectonic shifts caused by the coronavirus. And this, along with federal, state, and locally mandated shelter-in-place and social distancing requirements, really made forecasting the immediate future impossible. So the net was folks put pencils down on a large number of M&A activities. We'll talk about that in more detail later, and we'll explore how corporations have been reacting. But those have been the key drivers in the fallout that we've seen. There have been some hot sectors. We'll also talk about that later. But overall, in sum total, we've seen a major fall off. Richard, any other thoughts to share about the trend line that we've been seeing?
Sure. I can share, our anecdotal observations. Of course, the business that we're in, we have lots of conversations with people who are actively and planning deals. And, essentially speaking, we've seen exactly what you're saying, that people have the uncertainty has caused them to contract their activities to core business principles, right? Making sure that their employees are safe, making sure that they have continuity plans in place, are actually able to do core business. And it seems as though M&A activity has been sort of on the back burner for most people. So it's hard to argue with the logic of that. At the same time, and I think we'll discuss this, later in the presentation, is that we've seen a lot of people talking about, well, how do we tool up for when activity resumes? So we're seeing the exact same thing. I think it's unfortunate, but it makes a lot of sense, but it does present an opportunity for organizations to really prepare themselves for the future. So shall we talk a little bit about what we've seen in terms of their actual reactions, John?
Excellent. Sounds good. Let's move to the next slide.
Okay. So let's talk about what corporations are doing a bit as a result. I'll turn it over to you.
Sure. So, Peter Drucker, a famous author and thought leader, was fond of saying the greatest danger in times of turbulence is not the turbulence, it's acting with yesterday's logic. And I think that idea really typified the corporate landscape in late Q1 and continuing into this quarter. On March 11th, the World Health Organization declared the pandemic. The U.S. followed suit just 2 days later. And in March and April, corporations were taking extremely aggressive actions in response to the macroeconomic impacts and orders to close non-essential businesses and the shelter-in-place mandates. Looking at these charts, there's some very interesting data, and the two charts in gray at the top left of the slide are from PwC's Global Pulse survey. This particular poll was from their April 14th data set, and it shows that 77% of CFOs were reducing general OPEX and all non-essential spending, which is a phenomenally high rate of companies taking that kind of action. They were canceling planned investments, 65% cited that, and almost half were looking at changing their company financing plans. So the economic fallout of these actions has been devastating. A stunning 44 million Americans alone, not to mention the global impacts, filed for jobless claims during the past 12 weeks. And even today's jobs report showed another 1.5 million Americans filed for unemployment, the 13th week in a row that claims topped 1 million. Chevron, Boeing, Hilton, Uber, Airbnb, Virgin Atlantic, ClassPass Fitness, and a host of others all announced layoffs and or furloughs. And these numbers, of course, are really corporate numbers. They don't reflect the tremendous impact seen on Main Street. So I think, against the backdrop of COVID-19, and the impact on M&A, there are so many factors, but it was also very independent on industry, level of expertise, and where deals were in the pipeline. The pre-LOI phase of M&A, I'll cite a few data points from McKinsey and BDO. They were basically saying that deals were penciled down. as the situation was assessed and key leaders focused on business continuity and other operational requirements. The chart in the lower center, the M&A Leadership Council, which is a consortium of leading M&A advisory firms, conducted a targeted M&A specific survey in April with senior leaders and executives, and they reported that post-LOI deals were either being negotiated, renegotiated, or accelerated, and about 25% of all deals fell into that category. So teams were really compelled to reassess a variety of major deal factors: quality of earnings, supply chain impacts, material adverse clause impacts, financing, particularly in the debt markets, and risk-adjusted valuations were being re-explored. So a whole host of actions were in flight. Let me just pause there, Richard, and see if you have any comments before I make a few other comments about this particular slide.
You know, I think you touched on it, and we'll probably address this a bit later, but I also was thinking about what the changes will be in the consideration for due diligence, right? Because there are going to be a whole bunch of new areas that people hadn't had to think about before that now have to be consideration and preparedness for addressing another pandemic or things like that. So I know we will probably touch on this later, but I think it's a really interesting area that what is going to change in the not only the philosophical process and the rethink that they have in their approach to things, but actually in the very material elements of their actual process. If that makes sense. So I think there'd be, you know, when we get to that point, it'll be a very interesting thing to cover.
Absolutely. So, you know, I think, you know, double clicking a little bit more into this particular area, diligence was certainly impacted as well. One of our clients reported that since they could not send teams out for diligence, and due to shelter-in-place requirements, they could not hire experts near the target co. They were essentially forced to pause diligence for weeks. And so there were a whole range of very deeply impacting situations that were occurring across the deal lifecycle. The Leadership Council survey that I referenced earlier reflects this, showing that 62% of executive respondents reported substantial impact causing delays and risks for deals either in due diligence and even for those that had moved on to post-merger integration. And specific to the chart at the bottom, 58% of respondents indicated either a full stop or a delay in integration efforts for deals past the definitive agreement. So, you know, as the saying goes, changing is what people do when they have no options left. And we certainly saw the macroeconomic situation caused by the coronavirus impacting all facets of M&A, as well as at the corporate level in terms of the actions that CFO and other leaders had to take to conserve cash and make sure that they could continue to service customers and keep their employee populations safe. You know, what was going on in the background of all of this, and another forcing function for the drop-off in M&A, is that strategic leaders and key leaders in the organization had to start scenario planning. How deep is the coronavirus going to impact the economy? Is it going to go for 6 months, 12 months, or longer? How do we implement our business continuity plan so we can continue to operate our businesses as best as we can, given all the federal and local mandates? How do we virtualize elements of our operating model and comply with regulations? And all this work is very time-consuming, very significant, and certainly took attention away for inorganic growth activities. But amidst all of this, Richard, deals were getting done. In the U.S., industrial and chemical sectors were doing well. Technology, media, and telecommunications sectors were closing deals. Financial services organizations were closing deals. And in Q1, while there was still some momentum from last year, 660 deals got closed and pushed over the threshold, which is you know, a reason for optimism. That's all I had on this slide. I don't know if we had a polling question next or just
we have a question next. Before we move on, though, I just want to make the observation that you know, amidst while deals are getting done, and to your previous point about virtualizing their models, one of the interesting things that I can say that we've also seen is that there's been a tremendous uptick in conversations with organizations looking to find technology and tools. You know, whereas before things were, I won't quite say nice to have, but they're more in the nice to have and sort of side of things. In my experience, these have become more necessary conversations. They realize that not only is it a way to offset particular challenges like we're having now, but it also potentially adds a great deal of value by doing things in a more robust and transparent fashion. So I've had more conversations, and I think my colleagues have had more conversations about how companies improve their capabilities, which is an interesting effect as well.
We fully agree. Many of the best, highest flying stocks right now are those that deal with technology, collaboration tools, tools that enable operating models and such. And at a personal level, our interactions, face-to-face interactions with clients and even within our own consultancy are much higher due to the face-to-face interactions that we're taking advantage of, enabled by Microsoft Teams, Zoom meetings, WebEx meetings, whatever they might be. So very, very encouraging.
Absolutely. I'd like to go into our next audience poll question. I will launch that now. And it surrounds what types of deals you predict you will pursue when deal activity returns in the future. So we'll give people a minute or so to log their opinions. And I think we're seeing a fair amount of restructuring type of deals, which probably isn't surprising, given what's going on now and given the point you made earlier. In addition to which, we're seeing a lot of store closings from places like Starbucks and others, and so there will be an interesting repositioning going on, I think, in the future. Okay, I think we've gathered all the votes we're going to get, so I'm going to close that. And John, why don't we talk a little bit about what we expect to see in the second half of this year? I know predictions are tough, but what are you seeing? What is the data suggesting?
Sure. Well, Richard, I travel extensively for business, and as much as I'd love to have a dog, two adult cats who are pretty independent have found their way into my life, and they're very interesting, wonderful creatures. They either adapt to the situation in their environment, or they make the situation adapt to them, and either way, the cats win. And it's relevant to this conversation because after surveying lots of data and opinions from leading economists and government leaders and from research institutes and other consultancies and through discussions with our own clients, this cat analogy really resonates with that. Companies are adapting to the situation, or particularly wise companies are making this current situation adapt to them, and they're positioning pieces on the chessboard so that as we get into the new normal and build into the second half and 2021 and beyond, they're able to actually capitalize on this situation. So in terms of M&A, corporations are indeed adapting their M&A strategies to the situation. It's not easy. Adaptation on the fly leads to a lot of successes and failures. One of my favorite quotes is from Edison, who said, "I have not failed. I've just found 10,000 things that don't work." Right? So I think that's very instructive, and all of us are really challenged during these times to determine what we need to do to continue to service customers and to maintain our competitive advantages. So let's double click a little bit, into this data. Clearly, many industries are undergoing extensive financial and legal reengineering. Our finance and diligence partners and clients report, as an example, that the energy industry is, and also to a certain extent, real estate and transportation are going through pretty significant workouts. Taking a look at their debt structures, the financial structures, their legal entity structures, and they're trying to optimize the situation to, in some cases, survive, but also to position them to thrive later in the second half and beyond. And we expect that that'll be followed by an uptick in sell-side divestitures and distressed M&A deals and related transactions later in the year. The majority of our clients are telling us that they're re-examining their M&A pipelines, and they are seeing the possibility of not only divestitures, but also targeted acquisitions and mergers. And I think as M&A professionals start to get a handle on valuation, we'll see an increase in that. On the distress side, one financial services colleague related a story to us about how they were approached by a seller with an asset deal, and the sole purpose of that deal was to protect employees. They did not feel that they were positioned to survive. They really had a commitment to their customers and their employees, and so they proposed a private placement of the employees through an asset deal, and the transaction was quickly consummated with a very quick diligence process. So in the midst of all of the depressing news, there's also been a lot of really hopeful stories like that one. I think, there's a lot of pundits trying to draw parallels between the current situation and the Great Recession of 2008, 2009. And I don't know if there's really going to be that many parallels, but there is one lesson that we think folks are really thinking about. In the Great Recession, the credit markets froze, as everyone recalls, and many companies went into their own self-enforced lockdown. They stopped divestiture programs, M&A programs that was really driven by the steep decline in valuations. And as we exited the Great Recession, a number of consultancies showed that companies that made the bold decision to really optimize their portfolio emerged a lot stronger from their crisis. There was an E&Y study from back in the day that showed that companies that boldly continued on their strategies generated higher returns for shareholders as the economy accelerated. And we personally expect this lesson to resonate and contribute to the second half. 78% of respondents reported a planned divestiture in the next couple of years, and you'll see that chart there in the middle of the graph on the chart we're looking at there. And I think increased competition, which we see after every crisis, upends business models and allows companies to invest in new technology, new operating models, and I expect to see a similar dynamic toward the end of this year. So to that end, and beyond divestitures, I think we're going to see a lot of new deal types. Before I double click into that, Richard, just wanted to get your thoughts and impacts on what I've said so far.
Yeah, I agree with you. I don't know that I have any additional comments on the divestment side of things, but I think you're gonna click into this, and maybe while you are, you can kind of cover. I'm looking at, previously geographic expansion was a goal for many transactions, and given I see that there's going to be an impact, people are agreeing that there's an impact on that. But I'm curious, and I think we'll cover this again later, but what do you think the real impact will be? Because how do you, for example, cross-border deals and such, how do you really integrate a company when you have the inability to engage on a one-to-one level, despite having major cultural, challenges to overcome? And so I'm wondering, will it be worse than this? I think will geographic deals, especially cross-border, essentially cease to exist? I mean, there have been some that have grew and some that have canceled. What are your thoughts? Maybe you can talk about that as you go through the data here.
Sure. Well, the M&A Leadership Council study I mentioned earlier, it was exclusively focused really on the M&A strategy implications of the coronavirus, showed some very, very interesting data. Take a look at the bottom of that chart. It shows 57% of respondents will continue to do strategic revenue growth deals, similar to their core acquisition strategy over prior years. And so, the indication from executives is that they're planning on staying the course. And as we get to a point of new normalcy, they're going to go full bore ahead. Yes, we saw a substantial number of respondents say that they're going to be very opportunistic. But as you mentioned, Richard, 40% fully said that they're going to push into deals that help them with geographic expansion. So they're really looking to grow, both the top and bottom line through deals that are supercharging revenue growth or providing access to new markets, new customers. And that gives rise to a host of change management, communications, and cultural concerns, which we'll talk about as we double click into M&A capability required to support these types of efforts. So it's a bit counterintuitive in some ways, but also very, very encouraging. As an example, Verizon just closed May 18th on their acquisition to acquire BlueJeans Network. And that's a deal that was announced in April, if I recall, and it moved very, very quickly from announcement to close. And that was more than just an adjacency deal. Verizon is really intending to grow and leverage their emerging 5G technology to produce and leverage BlueJeans for much more advanced video conferencing capabilities. So they're really looking at megatrends, the work from home trend, and kind of the push to appropriate virtualization and work from home, and really trying to position the company for success. So, in aggregate, Richard, our perspective is that we're going to see a gradual L-shaped recovery, complete with a lot of fits and starts, we're sure, beginning in 2021. And we're thinking that by the second half of next year, we'll achieve that normalcy with an approach to return to increasing deal count and valuations over time that we've seen. But clearly, based on this data, there are a few very important takeaways. If inorganic growth is part of your company strategy, don't take a long hiatus. Leverage the time now to think about your corporate strategy, understand the deal types that you're likely to pursue, like the one shown here on the page, and assess your company's ability to plan, diligence, and integrate targets, extracting maximum value. And I think the companies that are beginning to think ahead here, as they're working through the planning considerations carefully, they're going to be the ones like the cats, right? They're going to adapt the situation to their own advantage and be positioned to come out very stronger on the other side of the current pandemic.
Great. So before we turn to our discussion to talk a little bit about how companies do take advantage of opportunities and their capabilities, I want to give the audience a chance to rate their own existing M&A readiness. So we have a poll here just basically asking you to rate your existing capabilities. We'll take a moment to give people a chance to register, and then we can go on and talk about what people can do and think about in terms of to improve that. Generally speaking, I think it's always interesting to see people tend to underrate themselves, but we have a lot of people, who are probably successful deal makers who are only saying fair, but it's interesting, and I think it's encouraging in that people are open to improvement and looking for new ideas, and so that's really good. I think we've registered about as many as we're going to get, so I'm going to close the poll. Let's move on to our conversation about capability and readiness and the model you guys are proposing for companies to look at.
Sure. So, it's interesting for those who rated themselves as fair, how are they doing that? Is it against the investment thesis of the deal? Is it, against other value drivers? It's an interesting discussion that we love to have with clients. But in any event, we're going to get a little bit more tactical here, having talked a lot about the macroeconomic situation that the coronavirus has caused and the actions that corporates are taking. So the real question is what can business development departments, corporate development departments, and integration personnel do right now? And while we've certainly had our share of bad news over the past 4 months, there are a lot of rays of hope. While there'll certainly be fits and starts, there are a lot of actions that folks can take now to improve their capability. So this chart represents M&A partners' components of M&A capability and readiness. And while this does not include every facet, we believe it's a good model to start the right dialogue about what's required for deal success. So kind of moving left to right across this chart, the first pillar is the M&A lifecycle framework. And in simple terms, this is a flexible, high-level, scalable roadmap that lays out your company's M&A process in phases. It describes the major actions that you should be taking from strategy through long-term value creation, including the phase gates where leaders get together and say, are we on track? Have we done everything we need to be doing in this phase to move on? And the shared framework helps keep all related resources aligned, moving forward effectively and efficiently. So if you don't currently have a formal M&A lifecycle framework, I'd encourage you to develop one. An analogy is a product development lifecycle, a service development lifecycle, and if inorganic activities are part of your growth strategy, this is really table stakes. Next pillar speaks to M&A leadership, governance, and resources, and that's just putting the right people in the right roles at the right time. This is likely to get much more difficult under current circumstances with leadership, integration leaders, functional workstream leads frequently being deployed on COVID-related projects or other strategic initiatives that are in reaction to that. For example, we serve a number of clients in the healthcare industry, and they, of course, are taking a look at reinventing their operating models as a result of the coronavirus, and so resources are stretched incredibly thin. So making sure the leadership, governance, resources, and budget are adequate for what you need to do, what you want to do is very, very important. Moving to the orange pillar there, that bright orange pillar, M&A program management and tools. Program management is critically important to successful M&A planning and execution. And we find that companies that are making a stronger shift to a diligence management office to really drive diligence are being served well. Because people are working from home, because it's more challenging to get on site during diligence, resources need to be utilized as efficiently and effectively as possible. And pulling together an overarching, lightweight, fit-for-purpose structure really helps diligence move forward as efficiently as possible so that resources can move on to other things or complete their day jobs, because sometimes M&A is a side of desk or second job. Likewise, corporations that are establishing formal integration management offices are de-risking the white space that can happen between functional teams and across business processes and systems that are often where integration issues occur. That's tied to functional capability and readiness. I'm not going to say a lot about that today, but certainly the more that companies can do now to understand functional roles, the functional process, the baseline integration plans, baseline budgeting for the expected deal pipeline, is those corporations are going to be more prepared. And if they take a look at that through the new strategic context and the deal pipeline that they see coming, the deal type DNA, as we call it, of the various deals that are coming down, they're going to be much better served. And then lastly, and I'll invite my colleague Michael Murray to give some comments here, it's really important to invest in the appropriate software, whether it be VDR tools, program management planning tools, or purpose-built M&A tools. Michael, if you would like to give a few comments to folks on kind of the relationship between software solutions and what we've talked about so far, I think that would be very informative.
Yeah, thank you, John. I'll talk about software solutions and playbook and readiness real quick, because they're both key components of the capabilities and readiness model. In fact, they make up 1/3 of the model, which kind of illustrates the importance of software and playbook readiness. At a high level, playbook is the documentation of your process, and M&A software allows you to plan and execute that process efficiently. So these two components are here basically to support and enable the other 4 capabilities that John just described. But it's important to understand the relationship between playbook and software, because these two capabilities work hand in glove. A little more detail on playbooks. It's a little more detailed than just documenting your processes. They are used to orient and educate your resources to support faster onboarding, reducing time to deal engagement. It aligns those resources in a focused, common value creation driven approach. It reduces ambiguity and uncertainty, helps improve the speed to value realization, and it helps define and create a repeatable, consistent process all the way from deal strategy to value realization. Software then is really the sister component of playbooks. Software also helps reduce onboarding and ramp up time of your team members and initiating new deals. It creates consistency and visibility across all the life cycles and across the various functional teams. And it critically provides consolidated view and management capability of RAID, which is risk, issues, and decisions. And something that Richard touched on a little earlier, which is particularly important in this new environment of virtualization, is it helps capture and document all of those disparate conversations, emails, spreadsheets, and the manual efforts required to create reporting. And it creates efficiencies within the team as a result of that automation. So those are some of the key components of software and playbook and how they relate to one another. But one of the guiding principles about software and the role of software is it is there to enhance the efficiency of the playbook and process. Therefore, an effective, well-designed process is a key requirement to successful software implementation.
Absolutely. And I would add the comment, and I don't want to become too self-serving because obviously we're a provider of these kinds of services. But in my experience in working with customers from a software's perspective over the past 15 years, we found that early preparedness, thinking through these processes, deploying some solution, whatever that solution is usually one of the factors that leads to a greater level of success than not. So I think that this is all part and parcel of the idea that, utilizing tools, thinking ahead, and being ready for opportunity is really a critical component of maximizing that opportunity. I won't, say more because I don't want to go into a Mergerware advertisement, but I think that's absolutely spot on.
Yeah, to punctuate the points that both of you are making, I've had the opportunity to work on dozens of M&A and D transactions over the years. I'm very honored by that, and I've learned a lot with each one. The very first opportunity I had was the HP Compact deal, and my supervisor and mentor said something I felt was very wise, and I think it would serve every one of our listeners today well, and that is the high-performing DMO, corp dev departments, and in particular the IMO, are really those that can leverage tools, process, software so that they are focusing on what really matters, the material aspects of the deal, the things that are driving synergies, the things that are delighting employees and driving that experience, the things that are serving other constituencies well, including their communities. Without software and solutions, if you are acquisitive or if you have multiple simultaneous deals, we found that integration management offices kind of devolved into a checkers checking checkers posture. And they're so busy with just keeping up with the data flow, documenting things, putting things into the repositories, and generating emails that they really don't have the time and the wherewithal to really take a proactive posture and say, what's going to derail value creation, 2 weeks out? What decisions need to be made? What data do we need to have? And so while M&A software solutions are not right for everyone, or they can be applied in different portions of the overall M&A lifecycle framework, for many, many organizations, I think they're table stakes, and they really help, resources which are costly to any organization really focus on those things on the deal that really matter. One final thought, and Richard, it's aligned with a question and a comment that you made earlier. You'll see the kind of bar at the bottom, M&A communications, change management, and culture. And thank you for bringing that up earlier. We've heard, and it's critical that every organization needs to look carefully at capability around these dimensions. M&A transactions at the end of the day are all about creating value, and that's always done through people. So, Richard, as you emphasized, you really need to double or triple down on your investment in this area in the current environment of, heightened uncertainty, as well as some of the additional challenges with operational execution. If you think about an employee in a target co looking at being acquired, there are many more concerns about what may happen. So
Sure.
our clients are taking stock of their capabilities, especially in this area, and they're investing. In fact, let me just punctuate all this with a couple of examples. If you're in a pencils down environment, or if you're looking at reassessing your strategy, or you're re-looking at targets, what are you doing? So ultimately right now, there's a perfect opportunity to really invest in any or all of these areas where you feel you might only be fair or good, as we saw from the poll. We have a semiconductor client right now that's focusing on governance and decision-making. They recently implemented a BU structure. They've got additional complexity due to the matrix organization, and they're really saying, when we re-implement M&A, how's that going to work? So they're really focusing on those aspects. We have a real estate client that's working on implementing purpose-built M&A software, and a transportation services client is doing the same. And we have a financial services client that's really looking at being more acquisitive in the next couple of years, and they're saying we need to really implement an overall capability. So I think it's incumbent upon us to take a look at our strategies, our corporate strategies, the role that inorganic strategy will play, and then be thoughtful about where we're strong and can capitalize on those strengths, and where we have opportunities and development areas and need to invest in some of these items.
Absolutely. And if I can just give one last example of the importance of the communication and cultural process, and what I mean is just a personal example. I spent a fair amount of time at Reuters, and they're a very acquisitive company. And at the time, I was involved, very tangentially in some transactions, and asked to do certain tasks. Wasn't given a perspective of what I was doing or why I did the work. And I can say that historically, they were challenged in integrating companies. And I compare that to my most recent organization prior to Mergerware, where we went through an acquisition. And while even was more senior, they did a much better job of communicating, sharing, and involving employees to find the synergies. And we had a much better more successful transition and integration. And I think that just proves a point that from the perspective of the teams who are sometimes doing some of the lower level work, having the perspective being communicated to, and having an easy way to understand their tasks and accomplish them is really critical. And so we think early planning, involving and facilitating that from all levels of the organization are the best ingredients for a successful transaction.
Excellent point. I do like quotes, and one that I think about from time to time is, it's not enough to just be busy, ants are busy. The real question is what are we busy about? And your comment is really all about value, right? It's a call to action to ensure that we've aligned the strategic intent of our deal with every downstream facet of execution. At the end of the day, and this is critical in these current times, that's going to help minimize integration costs. It's going to minimize required resources. It's going to accelerate your value realization, and you're going to be much more likely to meet the needs of your constituents. So, having the right capability that's fit for purpose for your deal flow, your deal type, your deal count is mandatory. So great comments, Richard.
Thanks. Let's move a little and talk a little bit about some of the planning considerations for execution, and maybe you can take us through some of the key areas that companies should consider as they work towards virtualizing their projects.
Absolutely. So, as we've talked about and alluded to throughout the webinar so far, articulating your industry's key trends, kind of the mega trends that are influencing your industry, whether it's overarching technology, customer and employee demographics, Macroeconomic and other data is step one, and understanding that is really critical so that as you build, enhance, tune your capabilities, you're doing so in anticipation of where your industry is going to go. And kind of double clicking in on that, what is your corporate strategy and what role does M&A play? So your expectations for deal type, pipeline, your approach to integration. Are you going to hold companies in more of a standalone posture, perhaps just integrating the back office functions like finance and HR, or are you going to go for full integration? And how quickly are all things that you can and should be thinking about right now? For those of you who have invested in developing baseline integration plans, do those need to be tweaked or updated based on the deal types you expect? A number of our clients are doing non-traditional transaction types. Some financial services organizations, for example, are looking at fintechs or insurtechs. And those are smaller, typically, more nimble businesses with very, very different operating models, very, very different cultures. So tuning your baseline plans and understanding the integration strategy, very, very important right now. Are there significantly different realities between your industry and others that you need to be conscious of? If you are in the energy, automobile, or transportation or retail industries, some of which were already struggling prior to COVID, then your investment profile is likely to look very, very different from a capabilities perspective than if you're in the distribution or logistics business, a highly sought after biotech company, or a fintech. So what are the constraints? What are the deal volumes and values you're anticipating? Figuring out that lay of the land is what we mean by new strategic context. Taking a look at the capabilities then through that lens is kind of step two, as we talked about on the last slide. Really taking a full stock, red, yellow, green of your capabilities across the deal lifecycle and seeing where tuning is required. And then lastly, upgrading key events and processes. One question we're getting a lot more of right now, even though economies, nations and jurisdictions are reopening, is what do I need to do to kind of adapt to what we think the new normal will be, which will be a lot more work at home, a lot more virtual execution. And so as an example of what some of this may look like, let's think about integration big events like day one, like big room planning, where you're looking at dependency identification and management as part of integration planning, or systems consolidation cutovers, which are all very, very complex. Start thinking about the additional planning and support that will be required to pivot your current process to support that in a more virtualized environment. It takes more time to plan, sometimes more resources to plan, and certainly different facilitation than typical. Often these big deals need to be broken up into smaller chunks so that people can focus for a couple, 2-3 hours at a time, and then revisit over a series of days or even weeks to accomplish what we used to be able to do by flying people in from around the globe and doing it in a big room kind of forum.
John, one of the things I've been thinking about, and we discussed this briefly, that I think I'll throw out there is, in addition to some of the process areas that you have to plan around, but also what does it look like in terms of some of the specific activities you'll undertake? For example, a few years ago, I spoke about how due diligence, I mentioned this earlier before, is that due diligence had to change for companies who were acquiring software because of the advent of open source software, right? And so therefore, what did that mean to their true ownership of that service and all the other complications therein? And so I'm wondering, similarly, are there a bunch of new specific considerations that companies have to take look at because of COVID? Do they have to say that, is the business continuity plan, I don't know how you evaluate that, but let's say, is that an area that has to be evaluated? Are we concerned about things like network and our security protocols now that we have people who are working from a distance? I think that I'm curious what your comments on, will there be, and I know we can't deal with them now, but what are some of the changes that we will look to see in terms of the actual process of what questions have to be asked And should companies be thinking about that now, about what's important to them?
Yeah, absolutely. It's a great question, and we concur. I would say that at a high level, all of the complexities, all of the questions that needed to be asked before COVID-19 reared its ugly head still need to be asked, and there's a bunch of other stuff. As an example of that, many of our clients are taking a much deeper look through diligence at quality of earnings, taking a look at sales force execution. Supply chains and logistics organizations are taking a much deeper look at their supply chains. So understanding things at a much deeper level is really, really critical. There's a lot more focus early on in the deal-making process on material adverse effects, providing flexibility in the transaction documents and process to accommodate unexpected twists and turns that may occur over the next 3, 6, 9, and 12 months, and so on. So there's a host of factors. As we think about perhaps instead of the beginning of the process, later in the process, post-merger integration, communications and change management need much more focus and attention. Gone are the days when we could chit-chat, reinforce messaging, where leaders could engage more easily with their employees and reinforce the key points of every deal and what's required during integration. So leaders need to be much more thoughtful, much more intentional in using video conferencing, using email, using other mechanisms to reinforce the strategic intent of deals and to keep their organizations engaged and rallied behind the value drivers and what needs to be done to achieve ultimately the investment thesis of the deal. So I would say that in summary, Richard, companies that are engaging in M&A right now really have a series of additional questions that they need to ask across the deal lifecycle. I'm kind of telegraphing one of the next slides we're going to talk about. It's an excellent question and very pertinent to where we are right now.
Yes, I'm going to, we have one more polling question. I know we're coming to the top of the hour, so be quick. The next question I'd like the audience perspective on is about what tools you've adopted to assist with virtual M&A. And I'm curious, please check all that apply. In my conversations, we've seen all of the above. And it's a broad mix, and some of the most acquisitive companies, interestingly, use some of the most basic tools as well. So it's quite interesting. Okay, I think we've collected most of our answers. I'm going to close that. And let's move on now to some of the process improvements you would recommend and ask people to think about as they as they virtualize their M&A.
So this planning tool is just one of many that can help you think about some things that are important considerations for M&A right now. The chart is only illustrative of some of the more important areas to consider, and I wouldn't encourage people to think this as exhaustively comprehensive, but let's take a look at a few areas. First, diligence. As I alluded to earlier, COVID-19 is introducing a whole host of new risks that didn't exist before. So making sure that the functional workstream leaders are prioritizing their due diligence request list to include the new risks, of course, is important. And it is also forcing functional leaders to think about being more explicit about data that needs to be shared. One example from a client was related to IT due diligence, where they literally, instead of having to tour data centers, looked for a video guided tour or a FaceTime guided tour. They were more explicit about photographs of security protocols that they wanted to see in addition to the standard questions. And if you're working on a large public deal, of course, you may not be in a position to make those requests, but for small, private, and friendly deals, you can get into that additional level of detail, and we'd encourage people to think about that. To that end, if you can't perform on-site inspections, can you hire a local team and train them to do diligence for you to your requirements? What kind of meetings should be designed with target co-management to help develop the same sense of comfort and confidence that you're a good acquirer, that you might have gained by using, your dinners with them, your meetings with them, and your intuition, experience, and senses during an on-site visit. As another example, let's skip down to big room planning. How do you celebrate together on day one? There's always some kind of an acknowledgement. People are social creatures, and while many are comfortable working remotely, and if you were, you might not miss a face-to-face celebration, but many do. So what kinds of things do you need to do to create the substitute for the human connection that helps energize people, helps people get rallied around why the deal makes sense for everybody and will be beneficial for everyone, and takes us a step forward toward winning the hearts and minds of the employees that come across as part of the deal, and that really are the whole point of doing the deal in the first place. Discovery, readouts, integration work plan development, dependency mapping development, all these big room events that you could have done before in person need to be done in new ways. So all this is really important. And I think a lot of this is the soft stuff. And the soft stuff is the hard stuff, as the saying goes. So, we've blogged extensively on that. And it's much more that we can cover during this webinar, but I would encourage people to check out our blogs, check out other resources to think about ways that you can virtualize M&A. And of course, virtual program management has been around for years and years, and there's a lot of great bodies of work out there if you're looking for the basic blocking and tackling of project and program management. But M&A is kind of the superset on top of all that. It has some distinct requirements, and we hope this slide is going to be a good thought provoker for many who are attending the call today to think about some new things that need to be done differently and or enhanced in the current environment.
Absolutely. I want to just in the couple minutes we have left, and for those of you who have asked questions, we will endeavor to answer them offline as we're running out of time. I wanted to quickly talk a little bit about the M&A technology and tools landscape. I think this is important because, and for full disclosure, I spent a decade at a major provider of VDRs prior to Mergerware, and at the beginning the landscape is very different. There were maybe a handful of providers. It's now a very crowded field across the pipeline, data management, and project management spectrums. Interestingly, there's not much in the integration, although there are plenty of service providers, but in terms of actual tools. Maybe Michael, you can give us a little bit of a practical advice, not a recommendation, but as organizations look to increase their capabilities and potentially deploy software and evaluate the combination of tools, whatever, how do they start, right? So, what process can they use to evaluate their needs and then use that evaluation to help them select the most appropriate tools?
Yeah, so from an evaluation standpoint, it really starts with a very structured process, and it needs to be an exhaustive process that's requirements-based. So that means based on your specific requirements. All of these tools that are displayed here are good applications in and of themselves. What we find in many cases is it takes multiples of these or more than just an integration tool to make a full solution. So that's where you need to define your requirements, do the evaluation in a structured manner based on those requirements, not based on the sales presentation. In fact, the process we've developed incorporates over 100 specific evaluation attributes across 16 focus areas and 3 major categories. That kind of illustrates just how extensive this type of evaluation can be, and how important it is to define those requirements and then ensure that the solution that you implement meets the requirements.
Excellent, thank you. Well, we've actually reached the full hour, and so I want to thank our panelists and participants, John and Michael. We genuinely appreciate your expertise and you sharing our information. We invite you to reach out and learn more about M&A partners and obviously more about Mergerware. Again, we will distribute this presentation within the next 48 hours, I think, tomorrow for sure. And yeah, we really appreciate everyone taking the time to join us today and listen to our thoughts and ideas. And with that, I'll end the presentation. Thank you very much.
Thanks, Richard.